There's only one certainty in the financial markets that I have seen, and that is that fiat money will debase. That is absolute mathematics. So when you have 100% certainty, you need to take action to protect that certainty. And that's what Bitcoin is.
I've got three outcomes in my head that I'm juggling with. The 60% probability is we have kind of a very traditional cycle, and that pushes, Bitcoin up to the 100,000 to 200,000 range, and, all the other assets accordingly where they are on the risk curve. There's a 20% chance this early start is signifying something much bigger, which is the larger adoption and the more capital into the space, which leads to larger price rises than people expect, because people are quite scarred because the last cycle seemed shorter than most people expected. Everyone thought there was another final leg higher, and that never really happened.
During the great financial crisis, some of the ugliness that happened was people who were short or who needed protection on, let's say, Bear Stearns, but they had bought that protection from Lehman Brothers. All of a sudden, they're like, uh-oh, Lehman Brothers is going bankrupt. Now I need to go and buy protection on Lehman Brothers to protect my position that I had bought from Lehman Brothers as protection on Bear Stearns. You see the circularity of it. And that's where things get really, really ugly. And that's the credit risk contagion that exists in the market. So I don't want to get too technical, but this market exists. It's a very sophisticated market, requires ISDAs, which are swap dealer agreements, counterparty risk, collateral agreements, and it's played by the big boys, the big hedge funds. But nonetheless, these open market rates are exactly that. They are indications of risk, real indications of risk. These aren't fake. So anyone who says there's a zero probability of default by the USA over the next 5 years, you can go out and collect a premium for selling that insurance to someone because someone's willing to pay you money. Now, they might say, I love you, kid, but your counterparty risk is too high. Your credit is not good enough. But the big hedge funds that have ISDAs, well, their counterparty risk allows them to play in this market. So that's how I've, got my chops. Always look at credit markets for indications. Understand that life is always a probability. You play probability distributions. Risk is a probability calculation. So there's only one certainty in the financial markets that I have seen, and that is that fiat money will debase. That is absolute mathematics. So when you have 100% certainty, you need to take action to protect that certainty. And that's what Bitcoin is. You can value it using credit default swaps. That's one model. You could value it using stock to flow. I'm not a fan of that model. I need to be clear, but it doesn't matter. It's a model. And I've had some discussions online with people. I frequently say, I will give you a price target, but not a time. It's silly to give a price target and a time. It's too difficult, if not impossible. Markets exist to make you look stupid. Okay? That's why markets exist, to make you look stupid. So why are you going to give a target and a time? That being said, stock to flow is a model. CDS valuation of Bitcoin is a model. I have a price target based on a different type of model. All of this is nothing but going into a probability distribution of potential outcomes of the price of Bitcoin and why you should own it as insurance.
I've given up giving prices to people because people on the internet, they're just not nice. And so you get, Raoul says this, so-and-so says that, it didn't do that. So I'll phrase it a different way, is we're seeing a much earlier ramp in the cycle than we've seen in the past, which is very interesting. It's very rare to be this strong this early in the cycle. Now, we are front running some of the capital flows, and so there's probably some correction that happens by the rumor sell effect. But I think if the space continues like this and we start getting monetary easing and the other conditions that tend to jumpstart the business cycle again, then we should see a very strong 2024 2024 and most likely a strong 2025. The business cycles have been almost like clockwork, 2-year up cycles, 1 year peaking, 1 year down. And that corresponds. What's amazing is the Bitcoin halving cycle is the same as the debt refi cycle, which is, I think, what drives everything. It's the same as the election cycle. They're all the same thing. So, if that continues to repeat, then it should go until 2026 when that should be a bear market year. But, let's see. So I am obviously very bullish. I don't know. And I was talking to Nova about this yesterday. I've got 3 outcomes in my head that I'm juggling with. The 60% probability is we have kind of a very traditional cycle, and that pushes, Bitcoin up to the 100,000 to 200,000 range, and, all the other assets accordingly where they are on the risk curve. There's a 20% chance this early start is signifying something much bigger, which is the larger adoption and the more capital into the space, which leads to larger price rises than people expect, because people are quite scarred because the last cycle seemed shorter than most people expected. Everyone thought there was another final leg higher, and that never really happened. The kind of 100,000 Bitcoin, the laser eyes idea never got there. But maybe this time the shock is for excess returns beyond expectations. The other side that I grapple with as well is, well, maybe the whole cycle's front loaded, and in fact it's shorter but more violent in 2024. So those are the 3 scenarios that I'm juggling in my head with. But 60% probability is just does what it says on the tin and repeats what it usually does. For retail, it's just price action, and what's likely to happen is the moment the Bitcoin ETF is launched, the market will focus on front running the ETH ETF. If the previous front running made money, they'll do it again. So retail will get very interested, and ETH's a broad, deep ecosystem, and people are happy to get exposure to it. The institutions, it depends whether they give the yield of ETH in the ETF or not. If not, a lot of the institutions would prefer to own ETH itself, because then they can stake it and get yield. Because if you don't give them yield, some asset manager who launches the ETF's going to get rich. BlackRock, they'll make all the money because they'll get the ETH staking yield, and they don't give it to the ETF holder. And we've seen that very commonly in ETFs in the past. So I think that's the thing, because when I speak to institutions, they get ETH because it's just like, here's a bet on technology. It's a broader based thing, and we get a yield, so we can just sit on it, which they don't get with Bitcoin, but they understand the Bitcoin story as well. So they understand there's 2 different things here at play.